And in fact, it might signal that the Fed would at some point need to cut rates, of course. But it certainly doesn't signal that this is a set of developments that would necessarily cause recession. Well, if it's not a recession or weakness, why the need to cut rates?
The land of Arcadia.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And Janet Yellin says the coast is clear. Amazing. Former Fed Chair Yellin says bond recession indicator could mean a rate cut, not a downturn. Whatever that actually means. Let's dig in. Again, here's Janet Yellin, who said she doesn't think we'll see another financial crisis in our lifetimes. I'm expecting to see at least the beginning of it this year, if it's not already begun. But she doesn't see any signal of recession, although, goodness, the yield curve is inverted now, especially since last week's meeting. I think your bond yield's around 2.4% today, quite a bit lower. I mean, even last year, it got as high as 3.26% until, as expected, stock market, real estate market started running into trouble. And what happens? All the talk about tightening, raising interest rates has now vanished. Jerome Powell came out last week and said they're done. Here's Yellin. My answer is no. I don't see it as a signal of recession. In contrast to times past, there's a tendency now for yield curve to be very flat. And in fact, it might signal that the Fed would at some point need to cut rates, of course. But it certainly doesn't signal that this is a set of developments that would necessarily cause recession. Well, if it's not a recession or weakness, why the need to cut rates? U.S. is certainly experiencing a slowing of growth. U.S. economy expanded at 3.1% last year, now seeing 2.1% this year. Of course, those are the rather generous Bureau of Labor Statistics numbers. I would say they do not accurately reflect what I realize as a reality, so take that as you will. And I mean, I guess just ignore everything I just said, and here's a simple question. 10 years of lower interest rates, 10 years of expanded balance sheet. Ben Bernanke said this was transitory, temporary, whatever those cute buzzwords that he got were. And it's funny because last year, Jerome Powell had this appearance in front of Congress where he was saying, you know, as he was normalizing the balance sheet, he was going to get down to 2.5 to 3 trillion over the next 3 to 4 years. And I almost dropped my soup. I don't remember if I was actually drinking soup that day, but it was stunning because I'm like, wait a second, what? The new normal is 2.5 to 3 trillion. This balance sheet was 800 billion in September of 2008 when Lehman collapsed. So how is new normal 2.5 to 3 trillion? And then he adds on that's going to happen over the next 3 to 4 years. And I wrote back then, which translates into it's not going to happen. Sure enough, it hasn't. Now, last week, Jerome Powell says no more tightening, no more tightening of the balance sheet or raising of interest rates. And sure enough, here it is that on one hand, Yellen says, no crisis in our lifetime, and yet what are we doing? Talking about printing more money. So is what it is. Again, that's why I see the solution as gold and silver and select cryptos. Although there are other things aside from that, not just to say those are some of my favorites and the ones that I've studied and researched as a solution to this. I always liked how Jim Rogers mentioned agriculture and other commodities. Certainly if there are commodities that you have experience with and are familiar with, those can be great investments. But stocks, bonds, real estate, I'm very cautious of. That's not to say what you should or should not do. But again, I would say when making any trading decisions or listening to anything out of the Fed, keep in mind what they've been saying for the past decade. And now here it is, once again, when it's time to undo the stimulus, they're talking about rate cuts. So there you go. Hit the subscribe button. I see you soon.